Hello again. Welcome to the next video in the series, and continuing on from the bond crises to come, we're going to look at the European bond crisis that is brewing, and in particular we're going to be looking at Italy, because Italy certainly has been in the news at the moment, and I think it's a real problem in terms of the way it's actually starting to develop out. Now, what we have to look at is the relationship between a country's politics and the markets, because whether we like it or not, when there's political uncertainty, then there is a funds outflow and there's instability within that domestic market. And what we're seeing in Italy is a contest between the ECB and the new Italian government, which is more, in inverted commas, populist. So what is it exactly that is happening? Well, basically the Italians are fed up with austerity, and the new government has said, we want to have a budget deficit approximately of 2.4% of the GDP, and the European Union has said no, it's got to be 0.8%. So there is a conflict between both the ECB and Italy, and what this is doing, this is affecting the bond market, in particular the sovereign bond market, which I've said before in the previous video is looking very dicey, especially regarding the debt within the whole total Eurozone area. Now, let's pedal back a bit. Between May and June of this year, we've seen 72 billion worth of euros leave Italy, which luckily subsequently came back in when the Italian government was making the right sort of noises to the ECB. So what we're seeing is a lot of volatility within the Italian cash market. So this is something that really is indicative of a future crisis to come, because investors and especially cash holders are nervous and they're quite willing to move their money out, and in particular the money's going to Switzerland, which is interesting because that is a non-euro currency. It's not going into German bonds, it's not going into anywhere else in the euro. So again, nothing hurts financials as much as uncertainty, especially country uncertainty. Now, what does this mean? I mean, in October the 11th, the IMF had a meeting in Indonesia, and in that meeting the IMF basically, and in inverted commas the ECB, basically told the Italians, if you don't adhere to the austerity conditions, and this is really, really important, if you don't adhere to the austerity conditions, we will not bail you out in a financial crisis. Well, what does this mean? Well, it means that if we repeat 2011 and Italy goes its own way, then the European Central Bank has said, tough. But what we've got to remember about the European Central Bank, and I'll be showing this in another video very soon, is that the European Central Bank is dominated with German money. And there's always a very good rule in life: he who has the money dictates what he or she wants. So the Italians are in a bit of a quandary at the moment, because they know that their banks are, and I'll go into that later in this video, are in a really dodgy condition, and now their political situation is at loggerheads with the ECB, and this is a recipe for coming disaster. Now, what this means is that the government will have to abandon its principles if they go down the ECB way, and the bond market in particular is starting to get very nervous about this. What we've seen is we have seen spreads go towards the 400 basis points differential from the yield curve. It's 300 to 350 basis at the moment, and 400 is really the danger signal when we're starting to go to potentially see a liquidity crisis. So keep an eye on these particular bond yields, because they are very, the spreads rather, in the bond yields, because these are very, very indicative of liquidity problems to come. Now, as these bonds start to get more expensive, there's a knock-on effect, and this goes back to my idea of, or my reasoning of, an impending liquidity crisis that will start in particular in the sovereign bond market in Europe, Also in China, China's not looking too good, so we'll probably cover China in the next video. But in the sovereign bond market, it's very, very volatile in Italy at the moment, because the Italian banks have been holding up to 10% of their holdings in Italian sovereign bonds. Well, what does this mean? Well, the Italian banks are pretty insolvent as it is. There's some estimates that estimate that close to 500 billion is needed to bail them out. Now, obviously, with the ECB saying we're not going to bail you out, this is making Italian banks look a bit more fragile than they were before. So, is a Greek crisis potentially imminent? Yes, it is potentially imminent, because once the banks start to become illiquid, then you have no liquidity and you need an emergency relief funding. And if the ECB has said that they're not going to do this because the Italians aren't playing game with the ECB, there are two opposing sides. Now, if the ECB lets Italy off, then there's Greece, there's Portugal, and especially Ireland, and Spain. Spain is a concern as well at the moment. That are issues that are going into the tailwinds at the moment. So really, this is a battle of the gargantuans, because if Italy goes down, it'll bring the whole system down. There's no doubt about it. The euro will not survive this. But at the same time, if they acquiesce to Italy, there probably is up to €1 trillion that have to be found. Either that money has to be printed, or Germany has to foot the bill, because nobody else has got the money. And I don't think the Germans are going to do that. So what does this all mean for the Italian banks? Well, what this means is that as the bond spread increases and as the price of the yields increase, what it means is that the amount of debt, sovereign debt that Italian banks hold of their own debt, is starting to lose value rapidly. And more importantly, once the credit reference agencies downgrade, and it's not if, it's when, then the Italian banks won't be able to fund their short-term liquidity using the bond market, and worse still, they won't be able to sell the bonds back to the ECB. So they are going to have emergency funds relief. But when this happens, it's too late. So that's not counting all the bonds that are held by US banks in other balance sheets. To give you an idea of this, look at this graph here. We can see that here's the number between January and this month. We have seen a steady increase in the basis points, the spread in the basis points. This illustrates the problem that Italian banks and the Italian economy faces, and it's a serious problem. It's a serious problem for Europe. Now, if we have a look at this next slide, we can actually see the amount of Italian debt that the Italian banks have. To put a number on it, the Italian banks hold 375 billion of Italian debt, which represents 10% of the total asset holdings of assets in Italian banks. Now, that's a lot of money to start losing on what's already a liquid balance sheet as the value of these bonds go down, and they start to become illiquid, because it's not a question of if, it's a question of when they are downgraded by the credit agencies. When that occurs, well, it's going to be 2011, 2012 for Italy. So that means for US investors, you should be very wary of any funds that have sovereign bonds, because as I said in the previous video, sovereign bond risk has not been properly priced. So all of a sudden we're going to see Italian bonds are illiquid. Now, does that mean riskless? It means that the Bank of International Settlements and the rating agencies have got this completely wrong. Italy is, and therefore the euro is in a really, really, really serious situation here. And the media and a lot of investment advisors aren't coming this up, because it boils down to this. The 2008 crisis was a liquidity crisis caused by credit not being available because of a banking failure. Now, sovereign bonds are indicative of liquidity within the banking centre, and certainly in Italy's case, the ability to finance short-term obligations. Now, once you can't finance short-term obligations, you can forget about your long-term obligations as well. So this is a very, very serious problem that people aren't looking at. What's also important is that Spain is also starting to wobble. There's basis spreads in Spain that are starting to look really, really not good. So if we have Italy on one side, Spain starting to look a bit not so good. They had a 20 basis point move yesterday. Luckily, it came back a further 10 basis point today, but that's in one day. This is fragile. And another video that I'm going to be doing is on Ireland. And Ireland is very much a canary in the coal mine to watch. Not a problem yet, but because of its financial fundamentals, it is potentially a major problem. So what we're looking at, going back, is this pigs crisis has never really ended. Banks have absorbed all the sovereign bonds that they could to repair their balance sheets. And to some extent, most European countries have repaired balance sheets, but not the Italians. The Italians are suffering from a horrendous headache, whether it's through corruption or just bad management of non-performing loans. And who's going to pay? I mean, we also have 375 billion of Italian bonds that are waiting to depreciate. Who wants to hold something that's depreciating? We're going to see Italian bonds being sold by US banks, by other European banks, where they can, because they don't know where this is going to be. So going back on this idea of political risk, we're seeing this as a result of a political change in a major European country that is not adhering, as it were, to the ECB guidelines. Well, you might say, well, that's the Italians, but there's a lot of unrest amongst countries in the Eurozone. It's not just Italy. And if this austerity programme was to work, then it should have worked by now, but it hasn't. And now we're facing the end of quantitative easing in Europe. So these stretch lines are going to get much worse for the other countries that have had easy money. So it's very, very important to look at the sovereign bond market. This is not going to get any better. I'm going to certainly be doing more videos on European bonds, but in particular I'm going to look at China as well at the moment, because China is also a disaster waiting to come. And I believe that for American investors, we're going to get a double whammy, and it's going to come sooner than you think, and you better be prepared. We're going to get a double whammy from Europe and or China, and it may occur at the same time. Hopefully it doesn't, because then it's curtains. So I hate to be so negative, but these are things that are going on. You have to be aware of it. So I look forward to seeing you in the next video, and we'll go from there. Thank you so much. And oh, by the way, please subscribe to my channel. It's very important that you get updated as things occur, and I'll see you in the next video. Thank you.